Hello, and welcome to the quarterly context webinar for the first quarter of 2026. This webinar and these webinars are designed to help clients and friends of the advisory group cut through the noise that you might hear in the media and elsewhere, and instead focus on having helpful perspective that is designed to help investors remain disciplined for long-term goals. And if you have any questions, please pop them into the question box and we'll either see those as we go along or address those at the end. As usual, there's a number of typical topics, each one sometimes with a new twist that we'll cover today. One in particular is some sub-asset class projections and cyclicality that may be helpful in terms of understanding some long-term cycles and the idea that cycles are just that. They're cycles. Markets don't remain the same, despite how sometimes it might appear to be the case after an extended period of a particular asset class or two doing quite well. As always, we remind clients to focus on the space between things that matter and the things you can control. You can't control markets, you can't control politics, you can't control geopolitical tensions, but you can control how you respond and whether or not you develop and follow a strategy until your needs and goals change. As always, the advisory group puts clients first and is focused on providing advice that impacts lives positively, whether it's our personal wealth clients or the stakeholders of our endowment clients or the retirement plan participants of our retirement plan clients. And we have a combination of resources internally and externally from leading research firms, and this helps us provide the type of advice and investment structure and planning and guidance that's typically only available to much larger organizations and entities and individuals or families. Taking a peek at the economy and the numbers recently, rates held steady this last quarter after the big period of hikes when inflation had shot up. So the Fed hiked rates to try to rein in inflation. And there have been several cuts starting in 2024 and include a couple in 2025, and have settled in currently remaining at 3.5 to 3.75 rate range established by the Fed. Inflation has been fairly stubborn, cooled a little bit relative to near the end of 2025, down to 2.4%, but still not at the Fed's targeted 2%. So it's very slightly headed in the right direction, but has been bouncing up and down a little bit, and wouldn't be surprised if the geopolitical tensions and the conflict in the Middle East and the subsequent impact on oil prices will push inflation up further, but depends on how that dynamic evolves. In terms of returns, a weaker quarter, also partly because of that conflict and the uncertainty that created around global energy dynamics and other factors. So the S&P 500 as a proxy for the U.S. stock market was down 4.5%, and the bond market was flat at down just 0.1%. Interestingly, as we'll see later as well, there are some asset classes that have shifted. So whereas large cap growth has really been dominating more often than not in the last 10 years, was down 10%, whereas value, which had been lagging more often than not relative to large cap growth at least, was up 2%. So about a 10% swing just in one quarter. It's a good reminder of how important it is of maintaining diversification. There are other asset classes that have also been doing quite well. Unemployment numbers hovering about the same, 4.4. We're a little bit lower and then picked up between September and this February number of 26 that we're showing right now. And GDP had a revised number considerably down from the fourth quarter of 25 number of 1.4% to the 0.7% you see here. So some cooling dynamics for a number of reasons. Other dynamics or factors that are sort of either resulting from markets or impacting markets. The biggest impact on the stocks in general has been the rising interest rates. Even if the Fed didn't raise rates, market rates have gone up a little bit due to concerns about long-term economic dynamics and the geopolitical uncertainty that was mentioned a moment ago. So growth stocks cooled, and tech stocks were a big part of that, and Mag 7 were part of that as well. And the Magnificent Seven, the largest 7 stocks within the S&P 500, which are all growth stocks, and most of which are technology or some technology related, underperformed the broader market. This is something we've been talking about that is likely to happen because there's no set of stocks that can have such a consistent, strong result. And so it's important to diversify and maintain portfolios that are designed for different cycles, not just cycles that factor a small number of stocks. The oil, for example, went up to $110 a barrel. That's the highest since 2022. That's certainly impacting markets, the cost of doing business, and inflation expectations as well. These dynamics that are kind of the pushing of inflation and the unemployment remaining pretty stubborn continues to complicate things for the Fed, because the Fed has that dual mandate of focusing on inflation and employment, but trying to fix one tends to make the other worse. And so that was a decision they made in the favor of trying to reduce unemployment last quarter. This quarter they held rates steady, but that tension of rates and inflation still remains. Looking at news for the quarter, there's always a number of things that caused the markets to bounce around. A few that stood out were tensions over the Greenland talk in Washington, private credit, after a period of excitement about private credit, cashing out and causing some liquidity problems. The Fed, again, holding rates for the first time since July, so first quarter to have no rate hike in several quarters, rate cut. The Supreme Court striking down the global tariff structure, which gave markets a bit of confidence that there'd be more independence around economic dynamics, at least for now. And then ups and downs with unemployment, and all of this, and especially the geopolitical dynamics, led to some cooling of stocks, given what's the Iran war dynamics. And then right at the very end of the quarter, a little bit of a rally on the hopes that the war might end soon. So the market will be dependent in the short term on some of those, how the war progresses. In terms of actual markets, you can see the U.S. market down 4%, international stocks down only 1%, and emerging market stocks down almost zero, but just 0.2% or 0.17. Global real estate up, and the bond market essentially flat at 0.1% or 0.05. What I'd like to point out here as well in this circled area, over the last several quarters, in the last couple of years, there has been a negative number in this column because of the raising of rates during the inflationary period, and raising rates pushes bond prices down and created negative returns for a while. But the higher, now that rates are coming down, which boosts bond prices and therefore bond returns, that has now led to cumulative numbers showing no negative returns now. So that's something we have been talking about would be the case, and here you can see this is the first quarter where that's the case in a while. So bond markets continue to normalize. When we look at different asset classes or sub-asset classes, it's interesting now to note, as mentioned earlier, that large cap growth for the first time in a while has had a significant drop, whereas value is positive and blends right in the middle, and therefore that averages out roughly in terms of the returns. But a good reminder that even though large cap growth over longer time periods here is still remaining high, other asset classes are starting to catch up. So having an excessive focus to mega cap growth and large cap growth in general is a recipe for very likely for higher volatility in the coming quarters and maybe years as returns are expected to revert to the mean over the time more towards long-term averages, which would mean that those that have been overvalued and stronger returns might have more cooling. You can see some of that recent cooling here because this is the top one here is the S&P 500 because it's dominated by large cap growth currently. That downturn or the cooling of about 10% really pulled down this line a little bit. And that also pulled down valuations a bit into a little bit more normal territory, which may be a healthy dynamic and takes a little bit of the higher valuation risk off the table. But still, even though U.S. valuations have cooled a bit, primarily because of those Mag 7 coming down a little more and large cap growth in general, still relatively elevated compared to other regions of the world. And here we can see the value versus growth PE discount, the long-term average here. And so there's been some adjustment here as values picked up a little bit and growth has cooled off a little bit. Also want to reassert that some of those key themes by looking at some other numbers. As mentioned, mega cap growth has had a long, strong cycle, been a few hiccups along the way, but for the most part, mega cap growth and those Magnificent Seven have dominated the S&P's returns and led many other asset classes. But that kind of concentrated exposure of having the Mag 7, which is about 35% of the index, or the top 5 are about 30% of the index, that makes it a little bit more like a sector fund rather than a highly diversified index or portfolio. This is one reason we, in client portfolios, use the S&P 500, but also as an index fund, and then build around that and diversify further into other large cap stock space. If we look at these numbers here, we can see no wonder some people, if we look at the 15-year for international, for example, no wonder some investors said, well, why would we hold international if the S&P is doing so well, or if the growth index in particular, growth segment of the market is doing so well, with the broad value indexes somewhere in the middle. And so some have really doubled down on that and are probably suffering some consequence now because it's starting to reverse. And it won't be a smooth line, but it won't be surprising if there's some bumpy and more negative quarters for those asset classes or sub-asset classes that have been stretched valuations. So, for example, large cap growth, as mentioned, down 10%, whereas value up to small cap value up 5, international up 2, and for the year, still strong numbers for the S&P and growth around 18-19%. But small cap value up 28 and international value up 30. So maintaining diversification across a wide array of asset classes pays off over time. It's also helpful to note that some organizations are actually putting numbers to their some of what we were talking about here in terms of what's expected over the next number of years. So Vanguard, for example, has estimated or projecting that large cap growth has the lowest expected return for the next 10 years, whereas international, developed markets, large cap value, and small cap all have the highest projected returns. So this is important to note because if you just look at recent performance, especially going back more than a quarter or starting with more than a quarter ago, it looks like there's just one dominant asset class, but it's important to diversify, and that's diversification is paying off. Here we can see projections about the dollar weakening, continuing to weaken as well. So that would also bode well for international stocks and unhedged international bonds. Same projections around the recession probability, about 35%. So that's come down over the last few years from a high of 60% chance in early 2025. But 35% is still more than a third chance, and so shouldn't be discounted entirely as a possibility. Unemployment has picked up a bit And wage growth continues to cool, so this puts some pressure on the average consumer and the economy, because if wage growth is slowing and there are fewer workers, then there's less disposable income and less money to stimulate the economy. And 70% approximately of GDP is consumer spending. So this can put some pressure on markets over time. Talked about inflation. Numbers have come down, but are generally hovering around that 2.5% level that the Fed is still waiting and trying to get it closer to 2%. But recent Middle East conflict dynamics has caused the price of oil to spike up, and that will flow through into the broader inflation numbers if that persists. It's also helpful, given the war in Iran, to take a peek back at other events historically and how some of those highly concerning events that certainly have a big impact on people in that region and other parts of the world. Ultimately, however, in terms of markets, can cause short-term volatility, but the market tends to keep chugging along as things get resolved and as the market and economies absorb those dynamics and try to work around them to continue to have their economies be successful. As mentioned, rates held steady for the quarter. This is after a period of historically low rates, then ratcheted up to try to create some dry powder for the Fed, and then COVID happened, and rates were back down near zero for a while, and then the rate hike period, which, as mentioned, did produce negative returns for bonds and also created some stock volatility. And now rates are coming back down, but not down towards zero. The Fed would like to bring them back closer to that 2.5 or 2 to 2.5% range, 3%. The yield curve is the bond market's way of expressing an opinion, and for the first time in a while, we can see that overall there's a relatively normal yield curve shape. So this green line is what's expected a year from now, so shifting up, but not really inverted almost at all at the beginning here, whereas last quarter, the long end moved up, which helped uninvert the overall yield curve, leaving only short-term portion of the curve inverted. And now there's a small inverted portion of the curve, but generally reasonably normally shaped. And that question at the beginning here suggests implications or concerns about some short-term dynamics, but a bit more confidence about the long run of the economy. Consumer confidence continues to hover near a 50-year low, only 5 or 6 other points in the last 50 years that were lower. People being pinched with higher prices, because while inflation has come down, it hasn't been deflation. So it's just the rate of increase in prices hasn't continued at that higher rate that it was for a while, but that doesn't mean prices are actually coming down. They continue to go up, just not at the same pace. That plus unemployment concerns and geopolitical concerns and other dynamics are causing the consumer to just generally be concerned. And if that leads to less spending, that then slows the economy, as we talked about before. There's another dynamic that, especially in portfolios that we build for non-taxable or tax-deferred entities or individuals, where the selection of certain investment managers within portfolios that have a quality bias is designed to help provide a little bit more stable return in volatile markets and in normal markets. But because there's been more of a speculative run over the last number of years, higher quality stocks have been out of favor, and they do tend to do well when markets get bumpy. Some of that is starting to show up here in green, for example, in the short run. You can see, especially in the growth area, higher quality is now outperforming, and that's where the market was doing the worst. So higher quality growth managers are starting to do better. However, sometimes some managers, depending on which type of quality stocks they've selected, that can take a few quarters to play out. Sometimes that is what we call a delayed quality effect. For the year, however, you can see still a pretty big differential between high and low quality, with lower quality still outdoing that. But it looks like there's potentially the beginning of a shift there. Also showing the periodic table again as a reminder that markets are unpredictable, that by holding a broad array of asset classes, a diversified portfolio, it ensures that you always have asset classes that are performing the best without overexposure to those that are doing the most poorly. And the white box in the middle shows how a blend of all of those asset classes tends to avoid the very highs and the very lows, creating a smoother path over time and never hits bottoms. In terms of rules and regulations for the quarter, we've talked a little bit before about the Trump accounts that are starting middle of this year. That's designed around a fairly limited set of children born between 2025 and 2028. You can get a government contribution to start a Roth-like account, and employers can also contribute. And there's some question about whether the rules around this type of account will evolve. On the retirement plan side, there's been discussion around expanding emergency savings plans within retirement plans, options for increasing retirement income through products that structure income rather than traditional investment vehicles. And there have also been increased discussion and clarification around the use of alternative investments in retirement plans, where in March, the end of March, the Department of Labor created a safe harbor for fiduciaries for retirement plans that want to include certain types of alternative investments like private equity, real estate, or digital currency. We generally don't encourage the use of private equity because of liquidity and access problems and high cost. And digital currency, we don't believe is a true asset class. It is more pure supply and demand without underlying intrinsic value. And real estate we already do hold because it is an asset that can have can improve in value over time. Another thing for retirement plan fiduciaries to be aware of is that there's been a jump in the number of hardship withdrawals that have been taken in 2025, up from 6% or to 6% from 4.8 in 2024, and an average before the pandemic period of about 2%. So significant in that. A lot of that has to do with covering bills and housing costs, and this relates back to consumer confidence and the questions of wage growth being slower than inflation and people having a hard time catching up. And savings rates that went up during COVID because people were spending less and also have got stimulus payments possibly have been depleted, in great part covering the cost of higher priced goods due to inflation. And with those depleted, it's causing stress and people are needing to borrow from their accounts. We also have a number of new blog posts that you might find interesting. One about the Roth catch-up rule, the topic of AI and whether or not there's a bubble there, 2026 retirement plan contribution limit updates, so you can get clear about what the number is so you can increase your savings and maximize tax-deferred or tax-advantaged savings. We have a retirement plan education video for fiduciaries that can be helpful, especially if you have new fiduciaries coming onto your committee or want to have a refresher and then discuss that with your advisor at the advisory group. That can be a very helpful way to do that. And we will also be producing in the coming months a foundation endowment fiduciary video for fiduciaries as well. With that, we'd like to thank you for joining us today, and always welcome your questions and suggestions. And if you have other people that need the type of support and help and guidance over time that the advisory group provides, we encourage you to put them in touch with us so we can expand our impact. And by doing so, you're also positively expanding your impact on people's lives. I'll pause there just for a moment. I'll be looking at questions in a moment, but also wanted to very quickly highlight part 2, which simply covers the overall 5-step process we use with clients, some statistics about how investor behavior dynamics are not limited to individuals, but also sometimes to fiduciaries in prematurely replacing managers or making decisions based on recent performance. The potential value of thinking about short-term money in terms of what we call buckets and timeframes, so that you're optimizing return relative to the time frame without materially increasing risk. The business cycle and where things stand, and the shape of the glide path for the advisor group's custom target date funds, as well as the industry average, essentially, through the Callan Consensus Index, and the generally recommended stair-step portfolio change steps for those that are using target allocation funds in target retirement plans rather than target date funds. And an update that we discussed last quarter about the capital market projections, in case you'd like to review that again. And also information about the advisory group's team, internal and extended team that is designed to support clients both directly and indirectly with expertise and insight. Well, thank you very much, and we'll pause here for a moment and see what questions come in. Thank you.